bonds, government and corporate bonds, probably both shaken and stirred. You know, bonds probably should be part of most people's portfolio, especially given the admonition that most people agree with. You probably should make them a percentage of your age in your portfolio. And to understand them with or without the machinations of the mathematics is probably a good idea. You know, bonds have a priority of claim over common and preferred stock, means they're a little bit safer. They are debt instruments, and the corporates often have a face value of $1,000, and the government bonds often have a face value of $10,000, but that's not always true. Regardless, they are always priced, quoted as percentage points of face value, which is 100. And there's something called a basis point, that's 1% of 1%. And for a government bond of a $10,000 face, that's $1. To value a bond is composed of two components: the annuity of the interest payment stream, and since the face value is 100 times the interest rate, well, it turns out to be the percentage, and the face value is a single sum, and we always compute it again as 100. And, of course, we need an example. Let's say we have a bond that pays 10%, but we're going to value it, discount it at 6%, and it matures in 15 years. Well, we look up the annuity factor, 9.7, multiply that through, and the single sum against the face value at 100 at 0.417, and we get a total of 138.82, and it trades at a premium because it pays more than what we want. Had the discount rate been greater than the interest rate, then the bond would trade at a discount below face value. Bonds come in two versions: a bearer bond, meaning anybody that's got it's got it. Those are usually really large value amounts. And or a registered bond, that means your name is on it, and you can hold them personally in a safety deposit box or with the SIPC insured registered broker. Highly recommended. Bonds may have a coupon rate, and that comes from the old days when you literally clipped a coupon on the bond to get your interest payment. Bonds have different levels of risk as described in the bond's indenture or contract, the highest being a mortgage bond that has a specific asset specifically named attached to the bond. You can grab it if they default. A debenture bond, on the other, has general assets, non-specific, backing them up. And then there are revenue bonds, and they are generally associated with common carriers and governments. The mortgages and the debentures come in finer gradations. The mortgage bonds have a first and second mortgage. That's kind of obvious. And the senior debentures have a priority over junior debentures. These variations of risk, along with the worthiness of the business itself, are evaluated by Fitch, that's for government bonds, or by Moody's or Standard & Poor's, where they give them letter grades. Moody's is noted as having a trailing series of small letter A's, and above BAA, or if you like triple B in the case of Standard & Poor's, those are investment grade bonds. Lower are riskier junk bonds. Both Moody's and Standard & Poor's have finer gradations with 1s and 3s for Moody's, pluses and minuses respectively for Standard & Poor's. Thus, A1 with Moody's is an A+ with Standard & Poor's. Another kind of risk is interest rate risk. That is, how much the bond changes as a proportion given a change in its discount rate, which could be per changes in the firm's risk or the level of interest rates in society. It is generally, but not always, the case that longer-term bonds are riskier, and those with lower coupons, especially if they're zero, are risky. Well, a guy named Macaulay back in the 30s thought of the idea, well, could we immunize a portfolio or a business from interest rate risk? And it turns out that that's done by looking at the elasticity of the bond and making the equity zero change, so just the assets and its duration would equal the liabilities and its duration. Well, as it turns out, the duration interest rate risk for a zero coupon bond turns out to be the maturity date, 45-degree angle, if you will, because they're equal. And in the case of a perpetuity, it is 1 plus the reciprocal yield. Let's do a simple example. We have assets of 100, duration of 12 years, and liabilities is 60. The equity happens to be 40. And so, well, if we solve, we get a proper amount of 20 years for the liabilities. Well, bonds have some other notable traits. One of them is what's called a call provision, and that's for early redemption of a bond by the corporation, and it is to avoid having to repurchase the bond if rates fall, but the bond value would rise, but they get to call it back at face value plus a call premium. Corporations like a low call price, investors prefer higher. Corporations like them to be immediate, investors like them to be delayed. It's called call protection. So we can kind of summarize all of this. Safer bonds tend to be mortgages, highly rated, short-term, have a delayed or high call price, and pay interest. Riskier bonds to an investor are debentures, are low-rated, tend to be long-term, have an immediate or low call price, and don't pay interest. But wait, there's more. If one looks at the internal rate of return of a bond, well, that would be to the maturity date. And, but if there's a call provision, you might want to calculate that to that date instead. Well, to make this presentation complete, I should talk about convertible bonds, which were the darlings of the 1980s, 70s. Not so much today, and we will see why. Well, a convertible bond converts to common stock and would trade at the greater of the two. The assiduous amongst you might notice that that's really not unlike, say, a call option. Well, since call options exist now, but not then, these are no longer quite the darlings as they used to be. Keeping you fully informed with Dr. C Invests.